Hello, this is Prof. Aram, and in this video, I'm going to go over the third financial statement, which is the statement of cash flows. This statement explains the change in cash from one balance sheet to the next. How much cash you have generated from last year to this year. In other words, we're going to identify where the cash is coming from and where the cash was spent during this period. So why is this important? The reason that we care about this financial statement the most is that cash flows are the source of value. Cash is the king. We don't really care about this net income number. This net income is an accounting number, is an accounting profit. And there are some non-cash expenses here that affects this number. That's why we really care about the statement of cash flows, or how much cash you generated over the year. This statement uses information from both income statement that shows cash inflows, which is of course your sales, minus expenses, which is your net income. And then you're going to add back all the non-cash charges that you had, like depreciation, and then also consider all the cash outflows, such as dividends that you had over this period, dividends and interest expenses that you had over this period. You also use information from the balance sheet. And in this case, you're going to look at the sources and uses of cash. What are your cash inflows? These are sources of cash. And then what are your cash outflows? These are uses of cash. So if you see a decrease in an asset account or increase in a liability account, that's a cash inflow. The opposite represents a cash outflow. So a source of cash is an activity that brings cash to the firm. For example, when you sell your inventory, when you sell your factory or an equipment, the cash is coming into the firm. A use of cash, on the other hand, is an activity that causes cash to leave the firm. For example, when you pay taxes, when you pay interest, pay off debt, these are all uses of cash. For example, we can summarize all of that here. If you have a decrease in an asset account, for example, when you sell inventory or sell a factory, cash is coming in to the firm. This is a source of cash. On the other hand, when you buy some trucks for your firm, cash is leaving the company. So it's going to be a use of cash. On the other hand, in the liability account, when you borrow money, when you get a new loan, cash is coming into the firm. So it's going to be a source of cash. But when you pay interest, when you pay off debt, when you pay your suppliers, cash is leaving the company. So it's going to be a use of cash. In terms of the owner's equity account, when you issue new stocks, new shares, that's going to be a source of cash, meaning that the cash is coming into the firm. Or when you increase your retained earnings is a source of cash. But when you, for example, buy back shares or repurchase shares, that's going to be a use of cash. So whenever you look at these different accounts, you have to think about, is the cash coming into the firm or is the cash leaving the company? Here you can find out the sources and uses of cash by looking at the balance sheet. So for example, accounts receivable has gone up by $233 million here. That is usually a use of cash. When the asset side increases, that's going to be a use of cash. Or when your inventory goes up by 2, that's going to be also a use of cash. Net fixed assets goes up by 65, that's also a use of cash. In fact, the whole goal of constructing a cash flow statement is to get to these two numbers, to find out how much cash you've generated over the year and what would be the ending balance of cash next year. So let's continue this. You can also look at the liability account. Your accounts payable has gone up by 34. That means cash is coming in. Your notes payable has gone down by 73. That means you pay off notes payable, so it's going to be a use of cash. Long-term debt has increased by 46 million. That means that you borrowed more during the past year. That means your cash is coming in, right? And the common stocks and paid-in capital also increase. So shareholders provided more capital as well. So also source of cash, right? So we can summarize all of that. You basically start with your income statement. You have your net income, and then you have dividends paid. This is the information you need from your income statement. From the balance sheet, you have the increase in accounts payable and long-term debt. These are sources of cash. And then for the asset side, you have the increase in accounts receivable, inventory, and fixed assets. These are all uses of cash. So we can summarize them like this, add all the inflows and outflows, and then subtract from each other. You see that the change in cash from 21 to 22 is 56 million. But keep in mind, we need to categorize them in the statement of cash flows. You start usually with the beginning cash balance, and then you add all the cash flows from operating activities. These represents company's core business. Any cash activity that affects the net income of the company goes under this. And then you have cash flow from investing activities. This is any cash spent or earned from purchase or sale of any fixed assets or any property, plant, and equipment, such as factories or machinery or commercial real estate that you have. And then you add cash flow from financing activities. These represents changes in debt and equity, any interest that you paid, any dividend that you paid, any borrowing that you had, or any new equity issuance that you have will go under this account. And then you get the ending cash balance at the end. So if we can categorize them, you see that, for example, the net income is related to your operating activities, dividends are financing activities, accounts payable are operating activities, long-term debt is financing, and accounts receivable and inventory are usually operating activities, and then fixed assets are investment activities. So you can basically put them into different buckets and summarize them in a statement of cash flow like this. So you usually in the statement of cash flow start with the beginning cash balance. So this is the 2021 cash balance. You add the accounting profit or net income to this cash balance, and then subtract the uses of cash and add the sources of cash. So from operations, you have this. From the investing activities, you have 65 million invested in fixed assets, so down 65, and then you have decrease in notes payable, long-term debt, dividends, and all the other financing activities. Together, this shows that over the year you added 56 million in cash. So 104 million plus 56 gives you your ending cash balance here. That's why it's very important to differentiate between this and the other two financial statements. This is more important than anything else. So even though you have 474 million in profits, you only generated $56 million in cash. And this is what you can use to pay your bills, to pay your suppliers, to pay the bank, and invest in any projects that you want to invest in. This is what you can use it, not this 474 million. This is an accounting term, this is an accounting number, but this is 56 million is an actual cash that you've generated over this period. So I hope you find this video useful, and thanks for watching.